If you look at the headlines, the story of cryptocurrency seems pretty clear. It looks like a massive, chaotic casino defined by volatile Bitcoin charts, sudden crashes, and the occasional meme coin millionaire. But beneath that surface, the actual chemistry of the market is changing. The primary action is no longer coming from retail speculation. We are watching the quiet migration of the world's financial plumbing onto a completely new type of infrastructure. The largest asset custodians on the planet have abandoned the sidelines. Institutions like BlackRock have moved past observation. They are actively building financial products directly on top of these networks. Traditional exchanges are making the exact same move. The Deutsche Börse Group is currently pouring hundreds of millions of dollars into developing their own crypto infrastructure to handle institutional volume. It presents a strange paradox. This technology was originally invented to bypass the big banks entirely. Instead, the banks are conquering the technology to rebuild Wall Street from the inside out. The reason banks want this technology is because the traditional financial system is surprisingly slow. Settling a simple trade takes days and requires passing through dozens of middlemen, each taking a tiny fee along the way. Financial institutions have wanted the speed and efficiency of a blockchain for a decade. What held them back was the risk of operating without clear legal boundaries. That barrier recently collapsed. In Europe, the implementation of the MiCA regulation provided a single, unified legal playbook for 27 different countries. A parallel shift happened in the United States. Federal agencies finally drew clear lines between what counts as a legally compliant commodity and what counts as a security. With those regulatory gates thrown open, the institutional invasion could begin in earnest. The market is aggressively pivoting away from retail speculation and toward deep structural integration. The primary engine driving this shift is a process called tokenization, specifically the tokenization of real-world assets, or RWA. This animated diagram shows exactly why banks need tokenization. Look at a standard bond trade. It has to pass through a broker, then a clearinghouse, and then a custodian, stretching the entire settlement process out over several days. But if you place that exact same bond on a blockchain, you bypass all those intermediaries. A smart contract, a piece of self-executing code, verifies and routes the trade directly between the two endpoints in seconds. This is already happening to massive traditional assets. We are seeing London real estate, BlackRock treasury funds, and Japanese corporate bonds all being converted into digital tokens. Traditional finance has no interest in replacing the dollar with cryptocurrency. They are adopting this infrastructure because smart contracts are simply a vastly superior way to operate a ledger. There was one major technical hurdle that kept banks away for years: capacity. The original Ethereum network was too slow, too expensive, and far too congested to handle global financial volume. The solution came in the form of Layer 2 networks, a technological upgrade that pushed the crypto space out of its dial-up phase and into the broadband era. You can see how this works in this animated diagram. Think of the main blockchain as a highly secure but heavily congested single-lane bridge. Layer 2 networks act as massive, high-speed, multi-lane overpasses built directly on top of that original bridge. Because the data is processed on the overpass, the cost of a single transaction dropped from dollars down to fractions of a penny. But this efficiency comes with a significant catch. These massive new pipelines are largely controlled and operated by a few massive corporate entities, like Coinbase. To achieve the processing speed and low costs that Wall Street requires, the crypto ecosystem had to surrender its original core principle: true, trustless decentralization. As traditional banking and decentralized networks merge into a single system, the firewalls protecting the broader economy disappear, introducing severe systemic risk. The fragility comes from the bridge between systems. If a major digital stablecoin, a cryptocurrency pegged to the dollar, fails, it acts as a contagion point. Because those stablecoins keep their reserves in real-world assets, a digital collapse would instantly trigger panic and aggressive sell-offs in traditional bond and equity markets. A crypto crash is no longer isolated to speculative retail traders. It is now a direct threat to the stability of the global economy. Looking ahead, the word crypto is going to gradually disappear from our vocabulary. It will fade entirely into the background, operating as invisible digital infrastructure. You will likely have your mortgage settled, or your concert tickets verified, entirely on a blockchain without ever knowing it's happening. In the same way that email made sending information completely frictionless, this technology is making the transfer of value instantaneous. The underlying technology proved its worth. It succeeded in upgrading the world's financial plumbing, but Wall Street won the war for control.